Good morning, everyone. My name is John D'Antona. I'm the Director of Marketing here at CAPIS. Welcome to our April monthly research briefing. CAPIS would like to thank all of you for taking the time out of your busy day to spend with us. We hope that you find the following information in today's brief insightful and that it sparks debate about the capital markets and trading strategies. But before we get started with market policy partners, the legalese. The opinions expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, CAPIS, any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and/or information presented within this presentation are for the sole use of institutional investors. Nothing in this presentation should be construed as an offer, invitation, or recommendation to sell or solicitation of an offer to buy any securities that might be mentioned. And now, on with the call. I'd like to turn it over to our special guest today, Market Policy Partners. But before I do, please note that John and Brendan will take your questions at the conclusion of their remarks. Please type them into the Q&A portion of your Zoom, and I'll be sure to get them. First, I'd like to introduce the gentleman at Market Policy Partners, John Fagan. From 2014 until 2018, John was director of the U.S. Treasury Markets Room, and prior to that, he was senior macro strategist for Discovery Capital Management, primarily responsible for Asian equity indexes, foreign exchange, and the rates markets. John holds an MPA from Harvard's Kennedy School and a JD from Harvard Law School. And now Brendan Walsh. From 2006 to the summer of 2018, Brendan was a senior analyst at Discovery Capital Management, covering global financial institutions, and was part of the global macro team, focusing on macro data, rates, foreign exchange, and equity indices. Brendan holds an MA from Fordham University in International Political Economy and Development, and was an international travel fellow to Manila, Philippines in 2004, working on econometric forecasting models. Gentlemen, as always, welcome.
Thank you very much, John. It's always a pleasure to be here, and we appreciate the platform that CAPIS provides us and your kind introduction. So we'll jump straight in and do about 20 minutes of presentation, and then open it up to questions, give or take. And so, coming into this year, the large macro tectonic plates had shifted in the fourth quarter of last year as the Fed backpedaled on its inflation posture from transitory to inflation fighting mode. This was the organizing principle of how we put together our forecasts for the how big financial market trends that we would see coming into this year, into first quarter and into second quarter. Our big calls were elevated equity volatility and persistent levels of heightened equity volatility as the Fed and global central banks pivot to a draining of liquidity and tightening of monetary conditions in the face of what we characterize as a supply shock driven inflation dynamic, which threatens to morph into stagflation. This was also motivating our call for a stronger dollar coming into the first part of the year as the Fed began to break away from the pack in terms of its hawkishness, and we would see volatility in risk assets feeding into a bit of a safe haven bid. And we had our third big macro call was the flattening of the Treasury yield curve. Our expectation was that tightening into what is largely a supply shock is a pretty challenging thing for the growth outlook, and that the cyclical slowdown that we saw coming early in 2022 would be deepened by the Fed and global central banks' actions. Our sort of fourth, I guess, in line in terms of market calls, it's one that we've been consistent on, is a negative outlook on Chinese assets. We had counseled our clients not to buy the dip as deep as that dip had become in Chinese stock prices. We didn't, and then we weren't expecting expressions of support to materialize into something significant in terms of stimulus this year in Beijing. We had a downside risk skew on our view to Chinese equities and also on the renminbi. And so the view that we had, it's played out, and in some with the four major calls, we were more neutral on commodities before the Russian and Ukrainian situation really went ballistic, and then obviously we like everybody else had flagged additional supply shocks as the upside risk scenario, and clearly that was materializing by the end of January into February. So this is a challenging backdrop for risk assets, and it has proven as such. This is a choppy year. We saw we expected a bit of a relief rally in the back half of March after the Fed got its first rate hike out of the way. But we think, and the classic motif of stocks rallying after that first rate hike, it's done and dusted. That's behind us. The waiting is the hardest part, and the stocks typically rise through the rest of the tightening cycle toward the latter half of it. We think this is just a different scenario, and it's been borne out by the Fed consistently upping the ante on tightening. We wrote a piece called "Green Means Go," which was subsequently a sentiment expressed by former New York Fed President Dudley that the Fed is going to basically take every rate hike that the market wants to give it, and looking at stocks going up is an indication to Fed policymakers that they may need to tighten or have the ability to tighten even faster. And so this was a formulation that really is an inverted Fed put, and I know that other analysts have, they're selling calls now instead of the puts. So it's a situation in which we think that risk assets and equities, although earnings season always has your positives and negatives, you kind of get that back and forth. We saw this dynamic last quarter. We're seeing it play out again. Netflix taketh away, and then Tesla giveth right back. And so this kind of directionless chop we expect through the heart of the earnings season, then to resolve back into a macro-driven market as we get further into the second quarter, which we think will be increasingly challenging as the Fed ups the ante of tightening as allowed by the markets. But we think that this is going to be coming alongside greater evidence of cyclical slowdown in the U.S. and global economy, which reasserts a focus on that more balanced set of risks, which looks stagflationary at this point. We think that there's certainly the case to be made that statistically inflation may have hit its peak. A lot of economists are making that point. And so that is at least optically a little bit better.
At least core inflation.
At least core inflation. Yeah. But as I know there are probably going to be questions on supply chain, we work very closely with a group of supply chain experts, the principal of which is out of the Department of Transportation, their policy shop, and their view is that the supply chain bottlenecks, largely owing to what's happening in China, but also certainly Russia-Ukraine situation, the supply chain bottlenecks are about to get worse before they get better. And we've seen this movie before where, Lucy keeps pulling the football away from Charlie Brown when it comes to improvements in global supply chains. Every time we think that there's, going to be a bit of loosening and a bit of normalization, something else seems to happen. So we think that this is going to be contributing to a stagflationary whiff in the economy that becomes more pungent as the second quarter goes along, and the Fed is going to be relatively, we think relatively downplaying of the growth risks into this period of time. Contrast that with the European Central Bank, which is very much more focused on the growth risks and less concerned about the inflationary upside. We see a lot of divergences between global central banks, with the Bank of Japan on the very dovish side, still much more concerned that inflation will relapse. And we'll talk a little bit more about the Bank of Japan and central bank dispersion. But But the Fed is certainly among the most aggressive now, and the thought leadership that we see out of St. Louis Fed President Bullard, he's usually kind of a gadfly, but he's been, calling the direction of the committee, and the rest of the committee has moved to his, to where he has been. And the last thing he said this week was 75 basis points. It's not a bad increment. So they just keep
not a base case, but not anything they would take off. And also, so Chairman Powell speaks later today at the World Bank IMF meeting. So this is his opportunity to fully price in the 50 basis point hike if he wants.
Yeah. And we think that is, that's priced in for now. And we think that is, the market is going to digest it. What we think causes a problem is when growth indicators begin to roll over in a more clear way. You can see that out in Asia, the sort of leading edge of the slowdown. You've got PMIs in contractionary territory in China, and beginning to waver around that kind of borderline contractionary in some of the the Asian upstream economies, Korea, Southeast Asia, and so forth. And we think that's coming soon to a theater near you. Obviously the U.S. is coming into this year in relatively good shape, household balance sheets and so forth. But we think that the supply shock and high prices do take their toll. And we have a not a thunderous slowdown, but a cyclical slowdown that the Fed really seems to look through. We think that ultimately the Fed around the July or perhaps the September meeting, where potential revision into September for this, the Fed is going to be moving back toward a more balanced formulation of its monetary policy, having had at least 2 and perhaps 3 50 basis point increment hikes over the meetings from spring into summer. We think that right now, as our base case is July, that they're pivoting to 25, but watch the space given the supply chain constraints coming out of China. It might be September. We think that is a crucial period for markets. When the Fed goes from 50 to 25, we think that there's going to be a significant relief component in the back half of the year, and that allows us, we think, to paint a picture of a year of 2 halves, essentially. Yep. And where we have a much more reflationary dynamic. The statistics, statistics aside, base effect aside, core inflation beginning to ease off, having that feed through from lower demand that we expect, the feed through from tighter financial conditions over the first quarter, second quarter, and feeding into the third. And it allows the Fed to begin to talk about how they're not, it's not mission accomplished on inflation, but everything's heading in the right direction.
No, and from the components of the March core CPI, if you look at that and you see things like the goods inflation, deflation still continuing, and the housing market, the shelter component not getting out of control, you do the math, and really core inflation CPI should be somewhere around 3% by year end, that's not scary for the Fed compared to where we're coming from.
Yeah, we've always had a very long-term view. Well, we've had a long-term view going into the COVID situation that the inflation spike would eventually play through. Transitory is a dirty word these days, yeah. But because it's lasted longer.
Car prices have added 2% to the annual rate. That's weird, that's not normal.
It's kind of getting overdone, and it's gotten overdone, and it's rolling over. We see some of these aspects.
Prices are going down again, which is a good sign for everybody.
Yeah, I mean, consumers are there was some, you don't want to put too much stock in one kind of data set, but the decline in prices in the stabilization of prices in restaurant food prices, because buyers are just they're going on strike. You can only have pricing power to some degree before you begin to eat into demand, and it seems as though we may be at that kind of stage as consumers shift into services and other purchasing patterns. But this is something that we think allows the Fed, as we said, to create that more balanced approach to its monetary policy. Not necessarily slowing down the quantitative tightening or anything on that, but just by going from 50 basis points to 25, we think is going to be a major statement, and a pretty big and a pretty big pivot point for financial markets. And so that is where we're kind of circling on the calendar to go on to to look for re-steepening more significantly in that sort of lead up into the July meeting, or perhaps into the September meeting, when the pivot we think is likely to occur. We're looking for the dollar to continue to ascend from here, not in a disorderly spiking fashion, but in a way where the next sort of leg is maybe sponsored by renminbi weakness. We'll talk a little bit more about China. We think that there's a good case to be made that the yen has had its big move and is ready to stabilize to some degree here against the dollar. But still, the big part of the move may be done, but we still like the dollar here for a little more room to run in terms of its appreciation over the second quarter and into the third. And similarly, our call on equities still remains pretty cautious, looking for elevated volatility, but for the clouds to clear up over the summer as the Fed pivots. Just a little bit extra on China. The watershed political moment in the fall when President Xi assumes his historical third term as president, and essentially president for life, cementing that kind of title in every important way. This is a year where we expect the Chinese to Beijing to stimulate to some extent the economy, to try to hold it together, and to use its significant powers of translating policy into policy thoughts into action, to keep the property market from sliding into a ditch with the credit difficulties that have been besetting it. And we think that the Chinese will be successful in doing so, but we don't think that that is going to translate into meaningful rebounds in the stock market. We think that the expressions of support that Beijing trotted out the other month for the tech sector and for overseas listings, we think that's rhetoric and hot air rather than substance. And I think that developments overnight, where it became clear that Didi wasn't going to get off with even a moderately significant penalty, and that Beijing is pushing for further, tells you there's some unfinished business on the common prosperity side. We think that remains a significant headwind to Chinese tech companies. We do not think that the U.S. regulators are bluffing when they talk about delisting companies that aren't playing ball. Beijing has said that they're trying to find a way forward. U.S. authorities have been less sanguine about the path ahead, and we think that delisting becomes a significant trend. A significant number of U.S. listed Chinese stocks do succumb to that. It is still a ways off, even for the first batch of them. And so we think that Chinese growth stabilizes at best, but the incredibly wrong-headed COVID zero approach, and we're all seeing that in the news, snippets of that in the news as to how that's being applied in places like Shanghai, and coming soon Guangzhou. The restrictions are increasing there. What that's doing to the port traffic, what the additional snarls into the global supply chain. It's worrisome. It's also somewhat baffling because the decision to enforce COVID zero looks so bad on its face. You can't help but wonder if something else is behind it, and that leads to some all kinds of wild speculation, but none of which is particularly supportive for Chinese assets. So I think suffice to say, we continue to label, to put a warning label on Chinese assets, and think that the strength of the renminbi, which persisted through the first part of the first quarter, is a thing of the past, and we think that it's going to have a managed period of depreciation against the dollar. Let's see what else is in the baseline, Brendan. Stablecoin regulation.
Yep.
Yeah, our view on crypto is that the regulatory must-haves that the Treasury and the SEC are focused on is about consumer protection, preventing money laundering and nefarious activities, and tax compliance. And we think that a lot of the other questions about jurisdiction and exactly how the authorities can define, where the different responsibilities of the different agencies lie is still very much a work in progress. We think that stablecoins, however, are going to be the focus of legislation potentially in the before the midterms. It could spill to afterward because of the lack of bandwidth that's available on Capitol Hill between now and then. But stablecoins is the one that we're set to watch most closely. We think it does have the systemic aspect that policymakers are most keyed in on, and certainly that tracks our conversations that we've had with administration officials and also people on the Hill. We think that stablecoins will end up being regulated in a way that looks a whole lot like money market accounts. And whether or not they may not go as far as making it a banking, you needing a banking license for it, but significant restrictions around how those can be played out. That's we'll pause there. And
the last thing is the midterms and the Build Back Better. So it's not going to be the Build Back Better bill, but they do have one more opportunity to do a reconciliation bill. Obviously the midterms are not looking particularly good for the Democrats. I think the House could be a bloodbath, but the Senate is a little more esoteric because you have some people retiring, new people running. So I don't think the Democrats have completely given up on holding the Senate, but they also understand that this is their last chance to do anything before the midterm. So I think basically you will have some sort of infrastructure spending bill that was the Build Back Better, and it'll basically be whatever Senator Manchin and Senator Sinema are willing to accept, and then everyone will start running for midterms.
Yeah, on that bill, it's a little hard to see where the Venn diagrams of what Manchin will accept and what Sinema will accept overlap. The idea of some sort of green technology investments, and and maybe some drug pricing stuff. That's probably about the maximum that they can get to. And the revenue is going to be sticky. Senator Manchin has expressed a willingness to do some of the fundraising, revenue raising approaches, but tax on billionaires is harder to implement than it sounds, and it's really not clear what Senator Sinema is going to stand up for after she pushed back pretty significantly on some of the tax provisions before, and so she's a bit of a moving target. I think
pretty much the big stuff.
Yeah, we can. Oh yeah, that's right. We can pause there and see if there are any questions from the audience.
Yeah, gentlemen, thank you for that. I have a question here from one of our viewers commenting on the SEC's exam priorities having to do with ESG, since we were just talking about that, and whether formalization of what constitutes ESG compliance is a focus in other government branches, including the legislature.
I think it's fair to say there are people in the legislature that are in Congress that are focused on it as a concept. I don't think that there's and obviously when you have an economic policy like this, there's going to be Treasury involvement. The Treasury Department certainly does have a thought process on ESG, and Secretary Yellen has made statements to that effect as well. I'm sure that there's a close consultation between the SEC and the Treasury when doing this, and certainly the White House too, I would imagine. The real issue is trying to come down in terms of what really constitutes ESG, and they're just a proliferation of standards. And the World Economic Forum is trying to codify some basic standards, but obviously there's pushback on the kinds of reporting requirements that it looks like the SEC is going to be seeking to enforce. And so the likelihood is, because they have a very challenging time, creating a standard of, what amounts to ESG and what doesn't. The focus is going to be on information gathering, I would guess. And so the disclosure component is going to stand in for for any sort of hard and fast rules on the ESG. It's just a very, very challenging to try to tackle it in any sort of quantitative, even qualitative way that creates those standards.
And,
so,
and the Europeans are years ahead of us on working on this, and they're trying to do that. So basically, the powers that be here in the United States kind of understand that, and we're just going to adopt what they end up adopting. So if you want to track where it's going, look across the Atlantic.
Okay, I have another one here. Just came in about looks like this green is dead. He's wondering if we're expecting such a poor Democratic showing in the House and quite possibly in the Senate. Is green dead?
The Democrats can't even agree to pass anything green. I mean, if they couldn't do it with all three houses, it doesn't look particularly optimistic for the future.
Yeah, I mean, I think that what we've seen right now, we wrote a piece for our clients, sort of changing the classic St. Augustine formulation. The Biden administration is, give me clean energy, but not yet. And this is
the Ukraine situation has only made that reality even more apparent.
Yeah, it's run into a really, really stark reality that the oil and gas and extractive and carbon economy and carbon institutions are not going away quietly, and they're determined if the policy makers are going to try to limit the number of or reduce the number of barrels that they're going to sell, they're going to sell them at a higher price, and that transition is that was always a possibility, but wasn't necessarily one that was going to be exacerbated by the kinds of geostrategic considerations that we've seen over the last few months. So this makes the challenge all that much more difficult. And you have countries and parts of the U.S. government as well that have been very committed to a green approach and reducing coal dependence and so on and so forth, having to go back and look at those decisions with some degree of regret, and realize that they are still, we're still in a carbon economy, and you can't decarbonize overnight, and the producers have a fair amount of say as to how that transition is going to happen and where the costs are going to fall. OPEC has been very unwilling to step to the plate and make up some of the shortfalls there, or change their reintroduction of supply on a month-to-month basis, and even beyond not upping the reintroduction of supply, not backfilling the shortfalls that they've been experiencing over recent months by the countries that have more capacity to produce. So they're not even hitting their targets, and Saudi Arabia, which could help top them up toward those targets, is sitting on its hands, and there's clearly a geopolitical component to all of this, and it's one that the Biden administration is being forced to a uncomfortable position where they're trying to get more U.S. supply. They're trying to they're trying to figure out how to protect some of their key climate equities and still have that long-term transition to the green economy on the horizon, while trying to backfill and generate as much near-term production as they possibly can. I mean, even reaching out to Venezuela, that shows you the level of you don't want to say desperation, but the prioritization to which this issue has come up, and we're still in a position where we expect the conflict in Ukraine to become as increasingly bloody, more atrocious, the terrible the terrible costs to the civilian population to get worse, as this continues, and to put the European Union in particular in a very tight spot when it comes to the energy. I think that this period, as we get into spring, summer, and fall, is the time where it's easier to make those decisions about increasing embargoes, trying to source others. They better make good use of this time, because if this conflict drags on to next winter, which it seems like, why wouldn't it at this point? Between now and then, the likelihood that some sort of terrible event pushes the European leadership to almost have no choice, to at least, to drastically reduce oil imports and even start cutting back on the gas, even though they're nowhere close to being able to make up for the shortfall that would occur if they started tightening those gas taps. It's a really challenging situation, and we think that green is still where they want to go over the long period of time, but this is a major detour. reality has intruded on the on the best laid plans here.
Okay, and I just got one that was referring to, you were talking about Russia and Ukraine, and this person asks here, aside from oil and energy, is there anything long-term as the Ukraine conflict crisis continues that will hurt the capital markets? Is it only about oil?
Well, food is such a pressure point. The places like Egypt, which is very dependent on Ukrainian grains. These are the kind of considerations. When you see global food prices going higher, this is what fuels unrest. We're seeing it in Latin America, we're seeing it in Sri Lanka, we're seeing it in in places in the Middle East. It's that's something that is it's a real challenge, and
that's what got the Arab Spring started. It was food shortages.
Yeah, and this is it's a very dangerous period, and trying to scramble for energy resources is bad enough, but when you're looking at the nutrition of large populations, it becomes even more grim, and certainly we don't have to worry so much about it here in the U.S. Processed foods and plenty, but there are even concerns in the U.S. not so much about supply, but prices, because of the questions about the planting season, the growing season here in the Midwest, and a lot is riding on having a good season. So it's that is certainly another geostrategic potential flashpoint, pressure point on emerging and frontier markets.
Okay, I got two more that just rolled in. First one is, do you have any thoughts on what's in store for the residential real estate market?
Higher rates take that one, yeah. Higher rates are clearly crippling demand, but the dynamic that fascinates me is basically in the last 2 years, we had 30-year rates, close to 2%, 2.5%, and basically everybody refinanced. So everyone's in a 15 to 30, but you also saw the value of your house massively increase. So, but now if you want to move, the 30-year rate is 5.5%. So I do think you're going to see a slowdown in turnover, simply because people don't want to give up their incredibly low, fixed mortgage rates. The big problem with housing really is supply. We just haven't built enough, and I don't necessarily see that being fixed anytime soon. Especially higher rates, increase the cost of building a house. So I do think we're going to see a slowdown in demand and a moderation in the price. But I don't think prices are gonna plummet.
Yeah, talking with, obviously, the Fed, exerts the property market is a big vector for their tightening. And we've seen some of the recent housing market data. Housing starts looked good, but some of the other mortgage activity and new home sales looked a little bit softer. We think that is, that's a feature, not a bug, for what the Fed is trying to do here. And just like the equity market going up in the face of Fed tightening, is almost a signal to them that, the property market continuing to accelerate would be a signal to them that they're not doing enough, or that they can do more in terms of tightening and to suppress inflationary pressures and the economy is strong enough, the market is strong enough for them to handle it. When it comes to talking with policymakers about it, they're focused on what can Congress do. There was some discussion with staffers on the Hill that we engaged in a brainstorming a while ago about, what can policymakers do? What from Washington, D.C., is there anything that you can do to help improve supply? And it's obviously, as Brendan pointed out, the input costs are really high, but the construction crews, and it's been a challenging time. There's a manpower deficit. In past times, immigration might be a fix for that. Immigration is very heavily politicized now and is in a sort of a challenged political space. There's even
beyond our immigration issues, the demographics in Latin America have changed, and there's less people coming across the border than there was 10, 20 years ago. So those jobs just aren't being filled because there's not the people to fill them right now.
Okay, I got another one here. The euro is approaching a 5-year low against the US dollar. Do you feel it will go lower by year end?
Yeah, our view on the euro has been that like the yen, the big part of the move is behind us. In our view, we think that the euro probably has the potential to weaken some further here. We think that we're still bullish on the dollar, and we don't think it's a big turnaround for the euro over the coming months. We think that there's a degree of stabilization. The huge divergence between where the Fed is and where the European Central Bank is, I think that's already well priced into this market. And the game changer would be, we think, if the Fed becomes incrementally more aggressive, extends their sort of string of 50s out to 3 meetings, or starts talking more about a 75, really front loading, that sort of thing. We think that is a risk of further softening of the euro beyond these 5-year lows that we're seeing, but we don't think it goes much past that. Our expectation is that it kind of loiters around. It ends up in a bottoming process, after weakening maybe a little bit more, but struggles to find direction until the Fed starts to pivot more decisively toward that balanced monetary, goes from 50s to 25s again. And we think that that's a cue for the dollar to come off its strength, give a little bit of more durable appreciation room for the euro and the yen, for that matter, in the second half of the year.
Right. Yeah.
But we think that this next leg of dollar strength is going to be focused more on basically China. We think that the renminbi is going to come, is basically going to be turning, is a battleship that's turning, and we think it's finally turned, and its stability, relative stability and strength in the early part of the year isn't where Chinese policymakers need it to be or want it to be, we think, particularly with the yen and other regional currencies losing a lot of value against the dollar.
Okay, I think that clears our questions queue. And with that, we're going to conclude our monthly CAPIS research briefing. We want to again thanks to our markets policy partners, John and Brendan, for participating and sharing their insights. Our next research brief will be on May 19th, featuring Katie Stockton of Fairlead Strategies. So we ask everyone to please stay tuned. Keep up with CAPIS on social media, on our LinkedIn, Twitter, and CAPIS YouTube channel, where you will find a replay of this event. On behalf of Markets Policy Partners and the CAPIS family, thank you so much for watching, and have a great trading day.